Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today, the hawk and the contrarian go head-to-head on tech to energy rotation, a decade-long shift. Let's get into it.
XOMCVX and COP all hit 52-week highs this week while Meta trades 33% below its own. Capital is flowing out of tech and into energy, and this isn't a trade, it's a decade-long structural shift.
A decade-long shift? That's a bold call when energy stocks are pricing in $100 oil forever. ExxonMobil at $170, Chevron at $212, COP at $134. These are fear trade prices, not fundamentals.
Fear trade? The Nasdaq 100 is sitting at $567, down 11% from its peak. XLE just printed $62.68, its highest level ever. That's not fear, that's repricing.
Sure, but look at what's actually happening with tech earnings. They haven't missed. The megacaps are still growing revenue double digits. You're confusing a sentiment drawdown with a fundamental breakdown.
Growing revenue while burning cash on AI capex that hasn't produced a dollar of standalone profit. That's spending without earning, and the market is finally waking up to it.
You could have said the same thing about cloud spending in 2015. AWS was a money pit until it wasn't. The AI capex cycle is an investment, not a loss.
Cloud had enterprise customers writing checks from day one. Show me the AI revenue line that justifies $150 billion in annual capex across the hyperscalers. It's not there yet.
Fair point on the timeline, but let's talk about the energy side. Energy is cyclical, full stop. Every time Wall Street declares a new energy supercycle, it ends the same way.
This isn't 2008. Oil approaching $100 with the Strait of Hormuz under Iranian threat, defense budgets surging globally. These are structural supply constraints, not a demand bubble.
Structural until a ceasefire headline drops and crude gives back $15 in a week. Geopolitical premiums are the most unreliable price signal in commodities.
Even strip out the geopolitical premium entirely, you've got years of upstream underinvestment. The industry hasn't replaced reserves at scale since 2014. That's not a headline risk, that's geology.
I'll grant you the underinvestment thesis has legs. But energy's valuation tells the real story. These stocks are trading like oil stays above $90 permanently. One demand shock and those multiples compress fast.
And tech is trading like AI monetization is guaranteed. At least energy companies are generating free cash flow today. Exxon's buyback yield alone makes the case.
Buybacks funded by a commodity price that's up 40% in 6 months. That's not a business model, that's a windfall. Meanwhile, the smart money is already rotating back into tech. Check the 13F filings.
Which smart money? The same funds that rode ARKK to $160 and back to $40? Institutional positioning is a lagging indicator, not a leading one.
That's a cheap shot. I'm talking about sovereign wealth funds and pension allocators increasing tech weightings this quarter. These are multi-decade holders, not momentum chasers.
And those same allocators have been increasing energy and defense exposure even faster. The regime change signal is real, it's not just retail traders piling into oil futures.
Look, I agree capital is moving. But calling it a regime change after 1 quarter of energy outperformance is premature. Tech led for 15 years. You need more than 6 months of data to call that over.
It's not 1 quarter. Energy has outperformed tech on a trailing 2-year basis now. The QQQ to XLE ratio has broken a trend line that held since 2012. That's your regime change.
Trend lines break and reform all the time. The 2022 energy trade looked exactly like this. XLE ripped, everyone called a supercycle, and then tech reclaimed leadership within 18 months.
In 2022, the Fed was still printing money and rates were headed to zero. Now we've got sticky inflation, rates above 4%, and a global energy security crisis. The macro backdrop is completely different.
Sticky inflation is exactly why tech wins long term. These are asset-light businesses with 70% gross margins. Energy companies need $50 billion in annual capex just to maintain production. When inflation squeezes margins, who suffers more?
Energy companies pass through inflation directly, they sell the commodity that causes inflation. Tech companies eat it through higher cloud costs, higher salaries, and compressed consumer spending.
We're going in circles. Here's my core point: the market is paying energy stocks for a perfect scenario that rarely lasts, while discounting tech stocks for a slowdown that hasn't actually materialized in earnings.
And my core point is that the market spent a decade overpricing tech's growth and underpricing energy's scarcity. The rebalancing has barely started.
Last word: every rotation trade feels permanent at the peak. Energy at all-time highs while oil is still below $100 is a sell signal, not a buy signal.
And every secular shift gets dismissed as a trade by people anchored to the last cycle. When oil clears $100 and stays there, we'll see who was right.
The hawk, the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.